Hello there, and welcome to today's webinar. I'm your host, Hiran Amin. Many investors are continually searching for ways to do more with less when it comes to their money. And that's what brings some of them around to the idea of trading options. See, selling options is one way for investors to potentially earn extra income on stocks that they already own, sort of like a 2-for-1 special for your portfolio. And that can sound pretty appealing at first blush, except it's not necessarily as easy as it may seem. See, trading options takes a lot of time, effort, knowledge, and of course, budget. So some investors may not be comfortable with trading options for themselves. But that doesn't mean that options are completely off the table for them. In fact, there's ways to potentially earn income from options without so much as glancing at an options chain, or for that matter of fact, even looking at a strike price. We're going to hear all about that in today's webinar. Joining us today is Danielle Neziol, VP of ETFs at BMO. She's responsible for ETF product development and strategy at BMO. She also helps lead the charge on educating do-it-yourself investors about how ETFs work. Danielle is going to share some hands-off approach to tap into options trading for income and some of the factors to weigh when deciding whether to pursue it. Danielle, thanks so much for joining us and being here as well. Now, I want to start off things with a trivia question for our audience. A study commissioned by the Chicago Board of Options Exchange, also known as the CBOE, in 2012 found that there were two options strategies which outperformed the returns of the S&P 500 index over the 25-year period between 1986 and 2011. What do you think those two strategies were? We'll reveal the answer towards the end of our presentation, so stay tuned. All right, let's get into our options talk. Selling options is one of the many ways that investors can generate income on their portfolio. But why might an investor choose to do so with options over those more traditional approaches out there?
Typically, when an investor starts to think about their portfolio, they're going to have a mix of equities and probably some fixed income, and it will match up with whatever risk return objectives they've set out for themselves. Now, some investors have specific income oriented objectives within their portfolios. And this is where a kind of typical broad equity market or broad fixed income exposures won't allow them to hit those income targets that they need. So, a lot of investors have been looking towards option strategies and specifically to selling options to earn premiums as a way to generate additional portfolio income for their investments to kind of achieve those income goals that they have. And what's been really appealing about writing call options that investors at home are figuring out and learning about is that the premiums generated when you sell an option, they're taxed as capital gains. So that income is a little more tax efficient than interest would be on the fixed income side of the portfolio. So these are some of the reasons why investors want to learn more about writing options, and they're more interested in getting option exposures in their portfolio for income.
All right. Adding another stream of income to their portfolio might sound appealing to many investors. However, trading options isn't as straightforward as investing in, let's say, stocks or bonds, for instance. So what sort of work goes into being an options trader?
With a basic equity portfolio, you're just researching your equities, but with an option portfolio, not only do you have to kind of research those equities, understand their risk return profile, understand the volatility that's affecting them, but then you have to understand the options overlay side of the equation, how those
Mhm.
options work, what strike prices make sense, what are your future expectations for those underlying equities, for market volatility. There's so much that goes into the equation that it is a lot to handle for an investor, especially a do-it-yourself investor at home who is kind of, perhaps learning on the fly or trying to figure this out on the fly.
Yeah. And absolutely, and to say the very least, there are certainly a lot more variables to consider when you're trading options, and it's not that kind of set it and forget it approach you might have with, let's say, stocks or bonds. Now, for anyone in our audience interested in learning more about what goes into being an options trader and how you can get started, please check out our webinar, Lessons I Learned in My First Year Trading Options, with our guest Bassem Zahili. Now, Danielle, options trading often involves using something called margin to further leverage and gain exposure to a larger position. But that can be rewarding, but it can also open you up to greater risks. So, why might this not be suitable for an investor who perhaps is on a budget?
Right. So investors at home or do-it-yourself investors who are thinking about margin accounts, they need to really understand just a few key things. So a margin account, you're using borrowed funds. So this is going to
Mhm.
leverage your investment. And what that does is it increases the risk reward profile of your entire portfolio. So investors need to kind of consider what's my risk appetite? How much risk can I take on? What's my time horizons? There's a lot of questions they need to ask themselves before understanding if margin accounts and managing margin accounts are right for them. So, the other thing to consider with margin accounts is this could force investors to liquidate stocks prematurely if liquidity is a concern to cover margins, and this would force them into selling out stocks at a time when they probably weren't planning. And then the most important thing, really, about margin accounts is just really considering that increased risk that's involved.
Okay, option trading sounds like it's generally very hands on and involves a degree of risk that not all investors might be comfortable with taking. That being said, for investors who are seeking an alternative to tap into options or potential income through options without actively trading them, they can consider investments like a covered call ETF. So, how do these products work in a nutshell?
Cover calls is such a great example of how ETFs can simplify the investment process for a do it yourself investor. So, everything we talked about, managing an options portfolio, all the considerations to make with a ETF, with a cover call ETF, an investor can easily and simply add that ETF to their portfolio and get access to an entire options strategy, the equity portfolio and the options overlay within a single trade basically. So the portfolio manager on the ETF provider level, they're going to manage that options overlay, they're going to manage that equity portfolio. They have all the resources and the expertise to manage it extremely efficiently and to the best of like their
Mhm.
ability. Much better than most of us at home. We don't have those resources or those time or the time to do that. And then these solutions are very cost efficient. So you're looking at an MER of about 0.72%. That's what we price our cover call ETFs at BMO at. That's the bottom line numbers. That's 0.7%. Very, very competitive pricing for all of that work that an investor really doesn't have to take on themselves with managing an options portfolio. And then lastly, with cover call ETFs, they provide usually monthly or quarterly cash flows. They're designed to give investors that cash flow that they're looking for if you're an income oriented investor. And they offer liquidity as well. So you can buy and sell them anytime when the market is open during the day. If you think about disadvantages, so I think for an options overlay just in general, one of the disadvantages or one of the things to consider is just that trade-off between income and growth. So when you're using that overlay, always remember that you're capping your upside potential on your portfolio. And then lastly, there is a fee involved with a cover call ETF. We have that MER. They are very competitively priced. Always good to do your research to see what other providers are pricing their ETFs at. But oftentimes that's much less than what investors would be paying to manage these portfolios on their own.
Not having to personally manage the risks that go along with margin and options as a whole. I think that gives a lot of relief to a lot of traders there. So let's get into it. Let's unpack the covered call strategy itself in a bit more detail, as it is one of the common ways to generate income through options. So how does this strategy work?
When you write or when you sell a call option on a stock, and writing and selling it means the same thing, you're giving the buyer the right to buy that stock at a predetermined price. which you'll set in advance. So we call this the strike price. So that's a very key term investors should be familiar with and understand before going into an options overlay or thinking about investing in options. So if the stock hits that predetermined price or that strike price, the option is going to, what we say, goes into the money. And then the option writer must sell that stock to the buyer at that price. Now, an important thing to also understand with option strategies, all options have expiry dates. Generally, they're 1 month. This can change, but we'll use this 1 month example in our model as we talk through this. So after that 1 month, if at that point that stock does not go into the money, we say that the option expires worthless. Now, either way, if you're writing the call option, you get to keep your premium, whether that stock hits the strike price or not. You keep your premium. But if it does go into the money as the option writer, then you're also obligated to sell the stock at that strike price to the person on the other side of the contract. So important concept to understand there. The closer to the money an option strike price is, the more expensive it'll be because the chances of that option going into the money are much higher. So if you're writing way out of the money calls, you're going to get much less premium because the odds of the equity hitting that strike price within a month, for example, is much less. However, as the option seller, if you're holding the underlying equity, we call this being covered. And the closer to the money you write the option on, the less capital growth you're going to receive from that stock. So closer to the money, you're getting a higher premium because the odds of that strike price going into the money are much higher. However, you're really capping your growth on that equity because you're going to have to sell it the second it hits that strike price. So remember when writing options, there is that kind of trade-off, that income growth trade-off between, depending on how far out of the money you are, in the money or at the money you are. So something to consider as investors when you're researching cover call strategies.
And something you just alluded to that I want to recap for our audience was the name covered. It comes from the fact that really that stock that you have acts as a sort of, let's say, a security or collateral against that option that we wrote. Now, for our audience, selling covered call is one of the strategies our guest Cody Ye speaks about in our webinar, How I Minimize Risks as an Options Trader. So make sure to catch that if you'd like to learn more about it. Covered call ETFs offer a mix of options trading income as well as gains through price appreciation from the stock itself that's within the fund. But how can an investor tell what sort of balance between the two they can expect from a specific covered call ETF?
So always important to understand that growth income trade-offs when you're looking at cover calls, and always important to do your research because every cover call ETF is designed a bit differently. And all this information can be found on ETF providers' websites, but you do have that little added due diligence as an investor at home to do your research and figure out how that income is being generated, how that equity portfolio is being built. How far out of the money the options are being written is one of the very first considerations investors should look at. So is that portfolio writing at the money calls? If they're writing at the money calls, then they're probably generating higher premium. So the distribution yield on that ETF might be a lot higher than another one. But if it's an at the money call, you're limiting your growth completely because there's no out of the money, there's no room to grow. So thinking about are the calls being written out of the money? How far out of the money or at the money is the first consideration for investors to really look at. And then an investor really needs to consider how much of that equity portfolio has calls written on it. Are the call options being written on the entire equity portfolio? Are they only written on half of the equity portfolio, which means the other half of the equity portfolio has unlimited upside? At BMO, we're deliberate in this. We've done a lot of research. We have found a sweet spot where we really like writing calls on just half of the equity portfolio to earn that premium. We write out of the money calls. We do a lot of modeling on the options to figure out exactly how out of the money we'd like to write them. as volatility does change and the markets do move. And then that other half of the portfolio that's exposed to growth that doesn't have option premiums, that has little unlimited upside. So we've found that that has worked for us and kind of our approach, but investors should do their due diligence, understand how those strategies are being run, but also understand the market environment we're in, right? So right now, investors are facing 6% inflation. So thinking about that income growth trade-off, you might want to think about the growth side a little more, or not ignore it completely, not be distracted by very high distribution yields on some products because of that inflationary environment. You may want to maintain some growth in your cover call portfolio.
And I know you spoke of market conditions and kind of volatility dictates that. So and something to allude to and let our audience know is that usually in heightened market volatility, something that we're kind of going through right now, uh, you generally try and push those strikes further out compared to closer because two benefits: the premiums are richer, but also the stock is also going to be moving in a much broader range at that time as well. Now, Danielle, let's say an investor is interested in maximizing that income that we just spoke about, that they're going to receive from a covered call ETF. What might they be looking for to choose the most suitable one then?
Okay, so if you're focused just on income and you don't, growth is not as important to you, it's not part of your investment objectives. So you're going to be looking for options that are written closer in the money or at the money. You're going to be looking for portfolios that have options written on the entire equity portfolio, not just half. This is how you can generate the biggest yield in your portfolio with writing calls.
Now, let's get to talking about management fees when it comes to ETFs, what we call typically the MER that investors must pay. How do management fees for covered call ETFs generally compare to just our standard ETFs on the market, as well as when you're trading options directly on your own?
Right. So we get this question a lot from investors. Why is a cover call ETF priced so much higher than my S&P 500 ETF? And it kind of goes back to all that work in the back end that we talked about with managing an options portfolio. So if you just think about, something like an S&P 500 ETF, there's much less work involved from the portfolio manager's perspective in managing that portfolio versus managing a options portfolio with the underlying equity portfolio, doing the extra modeling and risk analysis. So that's reflected in that MER, and that's why it's a bit higher. But at BMO, we price our cover call ETFs at the management fees about 0.72%, so zero point 0.7 of a percent. And this is still quite competitive relative to the landscape of funds overall. Now, I can speak for BMO. I know how we price our ETFs, but it's always really, really important as an investor at home, read the prospectus or go to a provider's website, understand how that ETF is being priced. Is that management fee or is that MER the bottom line? Is there a second layer of fees? You'll always be able to find this, especially in a prospectus. So just do your research to see where that's coming from.
All right. So with all that we know now about covered call ETFs, which types of investors might they be suitable for, and how might they fit this within an investor's portfolio there?
If you're thinking about how does it fit in my portfolio, how do I build a portfolio using cover call ETFs? We like to talk about the core satellite approach. So if you're a more income focused investor, you can certainly consider a cover call ETF as a core holding within your portfolio. You can make it a larger portion. There's so many options out there for investors, different geographies, different sectors, that they can really use these as building blocks to build a globally diversified portfolio with that options overlay, and then generate that added cash flow. For other investors who might be more growth oriented but are thinking, I'd like to boost the overall yield of my portfolio by a little bit, they can consider using a cover call ETF as a satellite. So kind of bolting it on, smaller position. They can try to be more tactical. A lot of cover call ETFs are sector focused. So if they'd like to make a play on a specific sector, but get that little bit of added income, they can bolt on a sector cover call ETFs in a smaller position in their portfolio. So just a couple different ways of looking at it. I also just wanted to kind of highlight the benefits, another kind of benefit for cover call ETFs. Outside of North American equities, there are international equity ETFs that have cover call overlays. It's really hard for investors in Canada to manage an international equity portfolio. So that's a benefit. There's also cover call tech ETFs. And when we think about
Mhm.
managing a portfolio of tech stocks, even after they've all cooled off and they've pulled back, tech stocks are still quite expensive. And you need at least 100 shares of a stock to write options on it. So again, gaining access to those higher priced sectors with that cover call overlay using an ETF.
Yeah, and you know what? I really like that point that you make because it really allows the investor to tap into and gain exposure to a wide variety of asset classes, that they may not traditionally be comfortable with investing on their own, but also geographically getting exposure to those different international markets and being able to use options against those as well. All right, final question for you, Danielle. What are some key factors that investors should consider when figuring out which covered call ETF is going to be right for them?
This is kind of how I break them down. There's usually sector ones that are focused on a specific sector. There's some that are focused on high dividend, and we didn't touch much on this, but a lot of cover call ETFs like to write options on dividend stocks because it really boosts that distribution yield because then you're getting your dividend income and your option premium income. So that's something to look out for. And then there's some that are focused on a specific geography. So Canadian equity, US equity, international equity. And again, these can give investors a lot of options with how they want to build out their portfolio. They can make a globally diversified portfolio of high dividend stocks with a cover call overlay, or they can focus on a sector cover call ETF, but understand what the underlying equity portfolio is. And then going a little deeper on that, what equities is the ETF writing options on? Are these very, very volatile equities? Are they high quality equities? Are they equities that you want to own? Because that is another important bit of research investors should be doing before adding these to their portfolio. Because even though a cover call ETF, we describe it as defensive equity, because of that added yield, often provides a bit of a cushion in down markets when you're thinking about the total return. Um, it is an equity position. It's not a fixed income replacement. So always good to understand that equity portfolio. The second consideration, understand how the fund's yield is being derived. So again, is it out of the
Mhm.
money, at the money? Is it sustainable? And this is something we always like to talk about at BMO because we really believe that trying to have a sustainable, steady cash flow income for an investor is just a really good investor experience. So just understanding, is it sustainable? If there's an underlying dividend mandate, are the dividends being paid by those companies, are they sustainable? It's a little more research involved, and some more considerations for investors looking at cover call ETFs. And then the last consideration or thing an investor should research, how frequent are those distributions? So if you're an investor who relies on cash flows, you may rely on a monthly cash flow from your portfolio or on a quarterly cash flow.
Mhm.
Um, every cover call ETF is designed a bit different. So just read the prospectus or check the website so you know when to expect those cash flows.
All right. Those are fantastic considerations. And, thank you so much for all of your insights, Danielle, on all of this. Very sage. And, we're not quite finished yet. We're going to head over to our live audience Q&A momentarily. So the Q&A box that you see in the console, use that to send any questions you may have for Danielle. But first, you're probably wondering, where do I find these covered call ETFs now? Well, I got you covered. No pun intended there. Let me show you how you can screen for covered call ETFs to get you started. Once you are logged into WebBroker, we're going to go ahead and head on to our screeners tool. To do that, we're going to click on this research tab up here. In the drop-down menu, we're going to head over to this third column that's titled Tools and go on to screeners right over here. And this is where we're going to begin our search to find some of those covered call ETFs that are out there. So from here on the screeners section that we're on, there's going to be a few, 4 sub-tabs, and we're going to head over to the ETF tabs because that's what our conversation is about today. We want to look for those covered call ETFs. Now to begin, we're going to go to create custom screen over here. And what this does is it presents these filters that will allow us to narrow our search to exactly what we're looking for. Now, one of the criteria has already been added is that's a country selection on over here. So I'm going to click on Canada because we want to look at some of the Canadian covered call ETFs to begin with. Now, the second one, and this is going to be only our next filter that we're going to use, is head on down over here to dividends. And in dividends, we're going to be looking at distribution yield. Now, the reason we choose this is keep in mind that these typically covered calls are going to be those higher distribution yields. And so once you have this filter turned on, we're going to select the highest of the distribution yields. Now, keep in mind that yields don't just tell the full story, but this is a place for us to begin to be able to look for those covered calls, as there isn't any particular category just to look for just covered calls alone. So now you can see once we've selected this, we've got quite a few matches that we find here. Now, keep in mind, we want to uncheck mutual funds over here because we don't want to include some of those. And we've got 267 matches that are coming up. Now, part of what you're going to see here is going to be a mix of just standard ETFs and as well as covered call ETFs. So just make sure you do go through the list and pick out the ones, and they're going to be usually labeled covered call as part of the name that they have. What is interesting from here is that you can actually do a comparison. So let's say you want to do a short list of a comparison against each other. We can click on the little box beside it. We can go down and find all the ones that are covered calls. And I'm not going in and I'm not picking. It's just kind of randomly I'm picking, just looking out for the covered calls at the moment. And so let's just do 4 of them over here. And we can hit compare. Now you can compare up to 5. And so what this does is a side-by-side over maybe some basic information that you might want to do comparisons against in terms of the net asset value, the distribution yields that they present, also the MER, some of the things that we spoke about here today. Once you've decided and kind of leaned on one of the ones that you'd rather get some more information on, and for example, CI Energy Giants covered call, I'm going to click on this. This is going to bring out a pop-up menu. As you see over here, and we're going to hit on summary. That's going to take us into a more detailed view about this ETF itself. Now, if we scroll down on this page, you can see what the asset class mix is like on this ETF, and it's mainly equities mixed between US and international, and a little bit of Canadian there as well. The sector it focuses on, of course, is energy. That's hence the name. It's an energy covered call ETF. Its geographic region, based on where the equities are purchased, are going to be across the United States, a bit of Europe, a bit of Canada, a bit of Latin America. And then if you wanted to see what is the actual holdings of this ETF, well, that's going to be shown right here under the top 10 holdings over here. And it's going to tell you the composition of how much weighting it holds. And from here, of course, keep in mind, if you do want to find out the actual strategy this ETF employs, then you want to go onto the ETF provider's website and check out the prospectus there. Okay, we hope that demo will help you get started in tracking down those covered call ETFs that you may be further interested in researching. Now, just one more thing before we head to our Q&A, and that's the answer to our trivia question. Now, as a refresher, the question was, a study commissioned by the Chicago Board of Options Exchange, also known as the CBOE, in 2012 found that there were 2 options strategies which outperformed the returns of the S&P 500 index over the 25-year period between 1986 and 2011. What do you think those 2 strategies were? And the answer is selling covered calls and cash secured puts. The study found that a strategy of selling at the money covered calls on the S&P 500 index in the 25 years between June 30th, 1986 and December 31st, 2011 returned a staggering 830%. Meanwhile, a strategy of selling at the money cash secured puts on the S&P 500 index returned 1,153%. In comparison, the S&P 500 index returned 807%. Now, both those strategies also exhibited volatility about 30% lower than the overall broad market S&P 500. And we are at a wrap for our interview portion here. Let's get rolling to our questions, as I'm sure there are many coming up there, and we're going to head over to our question and answer segment now.